Hi, this week we have 3 interesting webinars lined up for you. At 10 a.m. we have How Indian Equity Looks Right Now. At 11 a.m. we have India's Electronics Manufacturing, a sectoral overview. And at 12 p.m. we have Are Your Finances Geared Up for the New Year? If you want to join this webinar, register through the link given in the description.
As the calendar year draws to a close, it's very important to look back, introspect, and to draw our lessons from the events and progress made in that year. 2025 was a very interesting year because you had precious metals leading the pack, delivering the highest returns in a decade. Now, when you have such a strong performance in precious metals, you would think that probably the markets are gripped by fear and that equity as an asset class may not have performed. Surprisingly, the performance of the headline index has been very reasonable. It's high single digit, and large cap funds have actually beaten the index by a good margin in this year. Our mutual fund practice, which we do under Milestones to Wealth and ithought MFD, has actually done very well this year, ending up as a very consistent and stable performing entity. We have delivered performance to all our clients with a vintage above 1 year. How did this happen? This essentially happened because we chose to position ourselves, putting safety above returns. Interestingly, by seeking safety, we have ended up making more returns. Now, should we get the credit for the returns? Where I think we should be given the credit is in how we moderated risk in the investor's portfolio and decided that we would take risk only in asset classes like the precious metals, where the downside was low and the upside was unknown. Now, this unknown part is what has been the stellar performer in this year. Importantly, we tried our level best to make every investor invest in the silver ETF, and I must confess that we met with very high resistance, and our success could have been far higher if the investor was open-minded to our recommendations. Why were investors not willing to invest in a silver ETF? We even explained to them that this product is actually a product with a very low cost structure. There is hardly any expense that you are going to incur in this, but you must own it because it gives stability to your portfolio and could potentially give you good upside in a year when other asset classes are not able to give you upside. But it was extremely difficult to convince investors, particularly those who are completely driven by past performance. They were asking us a question, why are you not investing in the micro-cap index? Or they were asking questions like, why are you not investing in small and mid-cap mutual funds? We were telling them that the valuations were not appealing to us. So what these investors did was, they avoided investing through us in silver, went on their own to the platforms and bought small and mid-cap funds. The results of what happened to them are well known, so I wouldn't go into that. But what I would like to draw your attention to here is, avoid being blindly driven and led by past performance. Sometimes, when an investment product has the worst past performance, you're probably heading for a year when it is going to have its best current performance. And that is exactly what has happened in silver. But it is not just silver that was the reason for the superior outcomes that we have delivered in our mutual fund practice. The composition of equity portfolios, or the composition of the equity component in a client's portfolio, was curated with extreme care, keeping risks well in check. What did we do? We made the investor invest only in large cap funds. That was their major equity exposure. In addition to that, we chose two thematic funds which were defensive and cyclical. One is defensive, other is cyclical. So, the bulk of their investment was in large cap. Let's say out of the total equity investment, nearly 75% was in large cap, and the balance 25% was split between a cyclical team and a defensive team, which is acyclical. Now, this mix basically delivered very well for our investors this year, and their equity returns are well in excess of 15%. Now, this again only proves how managing risk is far more important than chasing returns, especially when you have had very high long-term outperformance in the riskiest parts of the market like micro-cap, small cap and mid cap. The positioning that we created for the investors is what has delivered this performance. The important point I want to make here is every year we decide what the positioning should be for the investor in the next year. We assess where the risks are within our comfort zone. We evaluate where the weightages can be higher in the next year. And we help the investor do that starting January. So the portfolio gently goes in for a restructuring and a repositioning. And by the time the new financial year starts, the client's portfolio is already set and ready. Even if we have to do a few things later, we already know what we want to do. And we wait for the right opportunity to do what we want to do. This is what has made our clients earn high teen returns in their portfolio of mutual funds. All clients who have stayed longer than 12 months, those who have a vintage of 15, 18, 24 months and even longer, have managed to achieve high teen returns in mutual funds through ithought. Milestones to Wealth again has had a tremendous year because there again we are aligning portfolios to the risk appetite of very small investors. Those who are salaried, those who are saving and investing towards their long-term goals which cannot be deferred and which cannot be averted. You cannot defer your child's education. You cannot defer your child's higher education. You cannot defer sending your child to school at the right age. So none of these can be deferred. So it's important that the goals are met financially through the portfolio well in time so that no goal is delayed and all the needs are met. We have done this in Milestones to Wealth simply because we have always kept the investor in a safe zone and yet taking risks which are well within his risk capacity and his risk appetite. Overall, our mutual fund practice had a very good 2025. We were positioned in a very conservative stance, and that conservative stance has delivered far better than even what an aggressive stance would deliver at the portfolio level. So we had outperformance in equity, we had outperformance in precious metals. What more do you ask for? Next year is going to be a challenging one. We continue to maintain a conservative stance. And we believe that investors should be more active in equity mutual funds, invest more regularly, step up their SIPs, make lump sums whenever we nudge them to invest, and grow their investment, that is the money that they invest in their portfolio, much faster than they did in 2025. Because I think that the beaten down parts of the equity market may remain low for 1 or 2 years and then start performing much better than what they did in the recent past. So you need to put in as much money into those funds before they start rallying away, and you need to push more money through that compounding engine. I see 2026 as the beginning of that opportunity to take on risk progressively and to make sure that incremental risk delivers superior outperformance and beats benchmark performance in your portfolio by a margin for a long time. In the next video, I will talk to you about the performance of our PMS products, what we did in our PMS, what we did right, what we could have done better, and what we should do going forward. Stay tuned.